Any information in this podcast is not intended to promote or recommend any particular product or services offered by Bell's Family and Associates. It does not take into account the objectives, financial situation, or needs of any investor. Before making an investment decision, investors should seek professional advice.
Good morning, Lucy. Good morning, Roni. Good to be back with both of you guys. When we're thinking about today and having Roni on, I was thinking about a story Roni told me about having pizza with Jonathan Shapiro last year when Jonathan Shapiro bought a bond. Jonathan Shapiro is a journalist for the AFR. The problem, of course, for Jonathan was while he captured a nice yield in terms of the bond he bought, if he holds it to maturity, his capital gains experience has been less than optimal because interest rates have gone up. And he was sort of looking at this, wrote an article about it. And I thought, well, you know what? This is the problem of credit markets. Are people effectively taking too much risk for the incremental benefit over government bonds that they are receiving?
Thank you, Gavin. Good morning, everybody, and welcome back to this week's Tomorrow's News. We are back with Roni Green joining us on the show as a monthly regular guest. For those of you who missed our last episode, which you can go and re-listen, Roni has over 15 years experience in global fixed income and credit manager, and he returned home to Sydney before spending the last 12 years in Hong Kong working for investment bank JP Morgan and building a Hong Kong credit hedge fund at Primus Asset Management. Roni has seen enough credit cycles from GFC to 2018 to COVID to help investors negotiate volatile fixed income markets. And this is one of the reasons why we love working with Roni. Beyond his very calm and easygoing personality, which many of you will get an opportunity to meet him in person in Sydney or Melbourne, and his amazing track record through these periods. Welcome, Roni.
Thank you for having me. Great to be back.
I'm going to leave you to an excellent discussion today. I'm looking forward to it.
Excellent. Well, thank you, Lucy, as always. So, Roni, let me set it up like this. Obviously, the big question, is there enough vig in the game as a credit manager? But I was reading a piece that Bridgewater put out on a couple of days ago. And when you read their piece and you look at everything, you look at the 10-year minus the 2-year and that spread, it seems like it's an absolute certainty that we're going to head into some kind of recession. Now, maybe more pronounced, maybe milder, or whatever. In that market, why are credit spreads where they are? And how do you make sense of it?
Yeah, look, it's a great question. So credit spreads had a big wobble, I would say, late last year and third quarter of last year. So we kind of got to reasonably cheap levels across investment grade and then high yield. And then the market narrative changed pretty rapidly to this soft landing to, I think we're currently at a no landing type of scenario. For me, I think it's wrong. I think credit spreads are, I'd agree with Jonathan Shapiro. Things are too expensive at the moment in the credit space. And I think it's better to be prudent at the moment. There'll be much better opportunities in the coming weeks and months. There's kind of, a lot of macro headwinds feed into the markets, and perhaps a recession, the likelihood of a recession kind of gets repriced into the markets.
Yeah, it's hard because it's consensus. But of course, markets are trading against consensus for a time. You can look at it to some extent in terms of the way that companies are trading after corporate earnings. I mean, NVIDIA, last night, I think NVIDIA was up 14% today on earnings that are down materially year over year. But now they're getting into AI, so we can be excited about that for semiconductors. But we do have a market that's pretty risk on, right? And if we look long term, it's certainly not that we see credit spreads as super punchy and all about greed, but they're right in the middle of the cycle, right? They're right in the middle of the zone by the way I look at it. And doesn't it just make more sense to own governments to the extent that you're going to own anything in the fixed income space?
I think the base rates moved up significantly, right? So, I was listening to Howard Marks this morning and, for instance, like US high yield was yielding about 4% this time last year. It's now closer to 9%. And most of that, if not all of it, is just from risk-free rates moving higher. But yeah, look, I'd point, even Jamie Dimon last night, he was quoted on CNBC as saying there's some scary stuff out there. And he would know, he would see it in the data, right? From all the credit cards, from the mortgage lending, et cetera. So all that a credit spread is compensation for default risk on top of government risk. So if there is a recession coming, or at least a slowdown, then investors should be getting compensated more to take credit risk. And, I think the right way to be positioned at this very moment is to be conservative. I think, like you said in your opening remarks, the yield curve is super inverted. So you get paid significantly at the front end. In fact, just this month, 2-year yields are up 60 basis points.
Yeah.
So as the market reprices, a higher for longer type Fed. And I think the risk that I'm most worried about as a manager is that, the long end has it wrong. And the long end needs to reprice higher as rates stay higher for longer or inflation stays more elevated for longer. So, as a bond manager, the risk reward there is not, I would say it's not great. I would say that I get paid quite significantly at the front end. And as credit spreads widen out, if that view of a recession plays out and credit spreads widen significantly, then that'll be the time to deploy the capital much more aggressively. I think things are tracking quite well in terms of the portfolio that I'm running. And, I just want to have the dry powder ready for, if we get another kind of bit of a risk-off panic October type last year scenario to deploy capital cheaply.
It's funny. It almost becomes like a meme, right? I can sort of send around, and sometimes I do, and then I realize I'm just being dull. But, I can send around the little snapshot of the, Brookfield defaulting on its downtown LA commercial properties, PIMCO defaulting on a bunch of office buildings. Funnily enough, though, I hear all kinds of vibe that actually everyone's trying to drive their staff back to the offices now because, of course, business is tougher, right? And so at the margin, maybe the stuff's happening at exactly the wrong moment. You've got that. I'm looking at U.S. regional banks. And, we're talking about something, I think you and I have talked to people about, which is there's nothing wrong with 6-month U.S. T-bills. They're over 5%, I think, today, right? But when you look at the impact on U.S. regional banks, the funds that have traveled out of deposit accounts, and this is kind of comes back to good old Jonathan Shapiro again, out of the deposit account, and it goes into money market, so it's no longer available for those banks to lend. That has a profound effect, particularly when you're seeing a tightening of credit standards, which we know we've seen for some time. It has a profound effect on markets, right? And I guess the thing that I was looking at something this morning, and you got to call me out on this. You got to say to me, Gavin, this is the dumbest thing you're going to say today. So I was looking at the US 2-year, okay? And I happen to look at a chart. I like long-term charts because they often tell you a little bit. Looking at the US 2-year, and I realized that the US 2-year kind of entered the same zone by way of yield, in a different environment, around about January of 2006.
Mm-hmm.
And it sort of stayed in the same range we're in now, the mid 4s and so forth, until July of 2007. We all know what happened then. But what I thought about, I'd love to get your view on, is that was a long time. It's a long time. So we talk about higher for longer, we talk about all this stuff, but do we just have to wait? Are you basically going to take up surfing for the next 6 months to keep you away from the screen so you don't do anything? Is that sort of the deal here? What do you think?
I wish, Gavin. I think typically markets don't bottom until they don't kind of bottom when the Fed's done. They kind of bottom typically when the Fed starts cutting, because there's generally like a panic, right? Like you can look back at the S&P or whatever, like the Fed kind of comes, or the RBA kind of come in, they cut rates significantly into a panic, and that's when we see the bottom of markets. So I'd say, like, from a timing perspective, markets don't get really cheap until the Fed's kind of in panic mode. I don't think we're there yet. In terms of like what to do in portfolio, so what I would say is a lot of liquidity has been withdrawn from the markets, I would say. And that's quite clear from removal of quantitative easing and moving to quantitative tightening. So just generally a lot less money around. So for someone like myself, it creates a lot of opportunities on the trading side. And no, it's not a complete trading strategy, but there are things to do to deploy capital for some kind of mispricings for kind of, 1 to 2 month type trades. So, I'm focused on that, and that'll keep me away from Bondi Beach. But yeah, look, I think at the moment, it kind of pays to be prepared for when that puke kind of happens, right? So what I'm spending my time now doing is getting ready for that puke. That's kind of what I'm getting paid to do. And the great thing about now is cash is not trash. Cash is getting, like you mentioned, 5% at the front end with no risk. So you add a tiny bit of risk on top of that, you can get an extra 1%, 2%. So, you're already up at 6.5%, 7%, just waiting around. So it sounds like a good deal for me. And when things get super cheap, well, there's a lot of value kind of in the belly of the curve or longer out, then, we can deploy capital and kind of go for kind of, mid-single digit kind of trading returns from those types of bonds. And there's, lots of situations where liquidity is kind of pulled out of the market. I want to have that liquidity available at the front end so I don't have too much mark-to-market pressure and can kind of deploy that in those cheap opportunities, which I think will come in the coming quarter or so.
Look, I mean, this is one of the things so critical. Look, and I've made every mistake. I try not to make them multiple times, but I've made most of them. And one of them that I often think about is you want to be lightly positioned so that you can be aggressive in moments where everybody's losing their minds, because these events do occur. The problem, of course, is patience, right? Either over trading or, just thinking, well, am I on the wrong side? So let's flip it around for a moment. It's not a view I hold, but there are some pretty smart people who are way more bullish than me, way more bullish. And they would argue, they'd say, all of you doom and gloom guys, you're missing something. You're missing the fact that real incomes are rising rapidly, okay? Because the Fed is actually doing its job. We're beating inflation. We're going to start to see house prices come off. We're going to, shelter as part of CPI. We got PCE coming out tomorrow in the US. We're going to start to see this rapid decline, which means that people's real incomes are up. Energy prices are down. Natural gas is at lows. Oil's at lows. There are all kinds of reasons to think that the Fed's about done in terms of the number of basis points of hiking it's going to do. That's starting to grip. And yeah, we kind of, consumer isn't tapped out. We can get a kind of a benign environment here for 6, 12, 18 months, kind of recalibrate and move on without an accident. And that means that while you've been sitting waiting, and I've been sitting waiting for the big one, we just miss out on return, right? We miss out on return out of those high yield bonds. We miss out on, now trading at 9% because those turned out to be good companies and they've cut costs now, so they're even better for a bond guy. Do you think about that, and how do we position that kind of view?
Yeah, so I think, for me as a bond guy, right, like if I miss the upside in the S&P, right, like it's not going to, like as a bond guy, I just, I want to miss the drawdowns, right? Like it's kind of like the market pukes that I need to avoid. Well, the defaults is quite frankly, is what I'm kind of trying to avoid here. So yeah, like the glass is always half full for me. But yeah, like I keep saying, at the front end, I'm getting paid to wait here. I think the key risk in your scenario is probably not there for me. For me, the key risk is that, 10-year treasuries kind of rally, or the yield comes back down to kind of like 2.5% because, inflation does go away exceptionally rapidly. And I missed that kind of upside, which is what happened in January. So in January, the indices were up about 3%. They've given that all back in February as kind of that narrative kind of disappeared with, what was it, the strong jobs number, et cetera. So look, I think that's probably the risk to me. So the risk is always for someone like myself being too conservative at the front end is missing the rally at the long end, right? So that's the risk. I think on the credit spreads side of things, like they're already tight as kind of you alluded to in the beginning, and my friend Johnny kind of wrote about yesterday in the AFR. So like, I don't think I'll miss out too much on that side. It's more getting that kind of like that rates positioning correct. But yeah, like I said before, cash is not trash now, and you're getting paid, 5% to wait. It sounds like a decent deal for me. I just add to your, just to your comments before, I think the whole reason the Fed, the RBA, et cetera, are raising rates so aggressively is to kind of pull out leverage from the system, right? To kind of make financial conditions tighter, which is actually, it's been the reverse, right? And that's, one of the pushbacks,
for sure.
One of the pushbacks on the Fed. But it's going to have a big impact. The US is a very finance-based economy. Australia is very levered to higher rates. So look, I think things will certainly slow down if we get into this kind of like just muddle through type period. And, that could be a Goldilocks period for credit. If it's just a muddle through, that's Goldilocks for credit. It really is. But again, things are not cheap enough. I mean, BHP just issued a bond last night, 100 over Treasury. It's not cheap, It's like, it's okay. You wouldn't be sitting there, trying to grab as many of these as you can, because just the risk reward is not great. I always say there's a rule of thumb in the investment grade space at about 200 over Treasury, the investment grade index. It's kind of just close your eyes and buy type levels. We're nowhere near that. We're closer to 100 here.
Yeah, for sure. No, we're sitting on LQD. I look at it, we're sitting on right like 106. And
exactly.
And, this is in a period where pretty much sort of in the middle of the, as I say, in the middle of the zone, if you will, right? But you're absolutely right in pointing out that the advantage for a guy like you is you can afford to sit in relatively short-dated instruments and get paid very nicely to wait. And so I guess a couple of observations there is, if you're right, it's actually not very good for global risk, which is sort of in my view. We're going to get a bit of a perspective on whether or not there's a new risk to global risk with Japan today with the BOJ. I doubt we're going to get any big change there, but who knows? But I think that it suggests that as people sort of look at the S&P at 4,000, or, they look generically at high yield at whatever, 80, whatever, and 74 on the HYG, that they're kind of like, am I really being paid enough here? I'd rather sit in a government credit in the short end. That drain of liquidity eventually does affect broader markets. I think it sounds like patience is the call here. I like how you're positioned around it.
Yeah, look, I think also, these are contractual returns, right? If you can buy bonds at, 7-8%, it's a contractual return, It's so like, what are long-term S&P returns? I guess they're, maybe 8 to 10%, depending on the time period you choose. So look, you're not too far off that, right? Just the other pushback is that last year, the lesson that I think a lot of people learned, and, thankfully we were positioned for it in the fund, was that you saw inflation coming. It was 8, 9%, whatever. So the view was, stay away from cash. It's the worst thing to be in because there's inflation, right? But you flip it, and actually cash was the best place to be, with, bonds down 15%, for 2022, and, equity and was also pretty weak. So look, I think, the market has a good way of humbling everybody. And that just goes back to my point that, staying at the short end seems like the obvious trade here. But, I think we've got to be very mindful that the long end of the curve, there might be some real opportunities there to add some alpha.
Hard to say that it's going to be from a higher level, but for my own book, I'm picking away at the 2 years. I continue to buy them every time they perk up here above that sort of 465, 470 level, because I think you're probably stopped out around 5.25 or so. We'll see. If I'm wrong about that, my futures, my S&P future shorts are going to work out nicely.
I'm sure.
Yeah. So, but, I think at the end of the day, your positioning is really interesting. And I think more than anything, and I've said this to people, that it's very difficult for the individual investor to have what I'd call a buy list ready. And so, I don't know, maybe today, the BOJ surprises the world and lets go of yield curve control. They won't, but, they do it, and it's a disaster tomorrow, right? Every global liquidity, panic everywhere, blood in the streets. There are probably 5 or 10 names you've got that you'll look at and you've got your level set. And I would challenge any investor sitting at home or who thinks they're smart, including myself, to go do that in a risk conscious way, right?
Yeah. Look, I think, all my experience from these kind of like macro shock events, the liquidity getting withdrawn from the market just creates a lot of opportunities in things that are totally unrelated to the BOJ, right? So, something in Europe, like an automaker in Europe, I don't know, just whatever you can imagine, just someone's long that and needs to sell that to kind of like repay a loan in Japan, like whatever it is. There's just lots of things to do always. The bond market being so big, so many players, people get tripped up all the time, and there's plenty of opportunities, and we will take advantage of them.
Roni, it's always a pleasure. So much insight. I know you're hitting singles and doubles every day, and that's wonderful. Long may it last. And we'll look forward to having you on again soon. Have a great weekend, and thanks so much for spending time with us today.